Hello everyone. In this chapter we're going to talk about fixed assets. Now sometimes you will hear the term plant assets, but fixed assets basically means property, plant, and equipment. Plant assets, basically, like I said, property, plant, and equipment. These are items that are assets when we buy them. And these assets are going to be used in the business, and they are going to be good for many, many years. Therefore, they're called long-term or non-current assets. You can think about them as long-term prepaid expenses. And the reason I say that is because, yes, it's an asset when we purchase it. Let's say we buy a vehicle. Yes, it's an asset when we purchase it, but as it's being used, a portion of that cost is going to be transferred, if you will, to the income statement as an expense, and we call that depreciation expense. I'm going to show you that as the chapter goes on, where we buy the assets, and then as we're using these assets, we will depreciate them, and then ultimately at the end of its life, we will dispose of those assets, either by selling them or by discarding them literally in the junkyard. There are different types of plant assets. The first category here is called tangible plant assets. These tangible plant assets are assets that have a physical substance. We're going to have buildings, equipment, vehicles, computers, furniture. If you see the consistency or the consistent factor in all of these types of plant assets that I am talking about, they are used for the business, and they have a long-term nature, meaning they're good for multiple years, and they have a physical substance. They will be subject to depreciation, as I mentioned a minute or so ago. And then we also have land. Land certainly is an asset. We will buy it, and we will actually record it as an asset on our balance sheet. But land is typically not subject to depreciation, because land is, in theory, going to be there forever. It's basically got an unlimited existence. The second type of plant asset is not a tangible asset, but an intangible asset. Intangible means it doesn't have any physical substance, but they do have a value to the organization. Patents, copyrights, trademarks, franchises, Goodwill are examples of intangible assets, and we'll discuss them a little bit later on in this presentation. And then last but not least, we have natural resources. Natural resources, obviously, it's limited to those organizations that sell natural resources, or I should say use natural resources, not necessarily sell it, but they could sell it as well. Oil, minerals, timber, and the like. Okay, so what we're going to talk about in this chapter is, number one, the acquisition of these plant assets. Number two, depreciating these plant assets. That's basically allocating the cost over to the income statement as an expense over the asset's useful life. And then the last part of this chapter is dealing with the sale or the disposal of these fixed assets, plant assets. Okay, first, acquisition of plant assets. The basic rule of thumb is all the costs necessary to get the asset ready for its intended use is going to be recorded as an asset. That would include the actual cost of the asset. Let's say we're buying a computer. The actual cost of the computer, the sales tax on that, the delivery costs, if it's a major computer and there needs to be some sort of installation, the installation costs. All of those costs are necessary and reasonable to get the asset ready for its intended use. They will all be an asset up front when we buy that plant asset. All right. Sometimes we're going to have repairs and maintenance. Repairs and maintenance is not part of the asset cost, and we'll discuss that later. The reason it is not is that is a current period expense. That doesn't add value to the asset. It actually just maintains the asset. So be very careful with that. Okay, all right, here's an example. Factory in Mississippi orders a machine from a Colorado tool manufacturer. The price of the machine is $10,000. Payment's going to be made in 48 monthly installments, which is going to include interest charges. Sales taxes of $600 is paid, freight charges of $1,350, installation and other setup costs for $500. What is the cost of the machine? Basically, the question is asking, what are we going to include in the asset cost? Well, basically everything listed here except for the interest. The interest is going to be a current period expense, but besides that, all the other costs, the price of the machine, the sales taxes, transportation cost, installation cost is all part of the asset. All the costs ready to get it for its intended use. Land, once again, land is an asset that we're going to record. The only difference is land does not get depreciated because in theory it's going to exist forever. And any cost to get that land title over to our organization, we can record as the asset part of land. Commissions to the real estate brokers, escrow fees, legal fees, any delinquent taxes that we might have to pay, surveying, draining, clearing, grading fees, all these expenditures are a part of the land asset. All right. One thing I want to say also with land is sometimes land is purchased with building and machinery and equipment in one big bundle. If that's the case, then we're going to have to allocate our purchase price to all of those individual assets. I'm going to show you an example of that in a few minutes. We also have land improvements. This is another example of a type of fixed asset. Driveways, fences, parking lots, landscaping, sprinkler systems. Yes, they're part of the land per se, but it's really an improvement of that land, really to make it useful for our business. Land improvements will be subject to depreciation because they do have finite life, unlike the land itself. But the driveway, the fence, the parking lot, the landscaping, the sprinkler systems, I think you can all understand that that has a finite life versus the actual land itself. Buildings. Like I said, you all know what a building is. Buildings is an asset. If we have to repair that building, that's an ordinary maintenance expense. That wouldn't be included in the asset cost. That would be an expense for the current period. But the building cost itself and everything ready to get that building ready for its use is going to be capitalized as part of the asset. Equipment as well. Okay, and this is what I was talking about before. Sometimes we buy these assets in a lump sum purchase. We basically get the building and everything in it. And that includes the land that's sitting underneath the building itself. Maybe there's some equipment in the building, furnishings, what have you. So usually what happens is we hire an appraiser. Here's an example where we bought basically we bought some land, and on the land a building was there and some equipment was in the building, and there were some land improvements around the property. And we purchased it for $800,000. So typically what's going to happen is we're going to hire an appraiser. An appraiser is going to give us the value of everything we purchased. So anyway, this appraiser came out, and you can see this first column here. The appraisal came back, and the appraisal for everything that we purchased was $1 million. Land was valued at $250,000 per the appraiser. Land improvements, $50,000. Building, $300,000. Equipment, $400,000. So we take the value divided by the total, and we get a percentage. As an example, building, $300,000 out of the total of $1 million appraisal, that's 30%. Equipment, $400,000 out of the $1 million, 40%, etc., etc. So what we're going to do is, if our purchase price was $800,000, which is the total, we're going to take the $800,000 purchase price, multiply it by the percentage of the total appraised value, and we will get the allocation. As an example, equipment was valued at 40% of the total appraisal. 40% times 800,000 equals 320,000. And you do the same thing for all four. So we are left with the 800,000 allocation as follows. Land is going to be 200,000 of it. Land improvements 40,000. Building 240,000. And equipment 320,000. You can see the journal entry as follows. We're going to debit all of the plant assets that we purchased using the allocation method we just looked at on the last slide. And we wrote a big fat check, so we will credit cash for the $800,000. All right, so those are examples of purchasing or acquiring the plant assets. Before we get off the subject, once again, any cost necessary to get that asset ready for its intended use would be recorded as an asset. They are called capital expenditures. However, once we have that asset and the asset breaks down and we need to repair it or maintain it, or basically just to keep it running, those are called revenue expenditures. And you are going to see that those revenue expenditures are going to be recorded immediately as an expense. It does not get added to the asset account. So be very careful. All right. The second part of this particular study is after we purchase or acquire those plant assets, we are now going to depreciate it. Now, depreciation, I don't want you to take this term meaning that you are going to compare the original cost to the fair market values, the current fair market values. That is not what I mean when I say depreciation. When I say depreciation, what I simply mean is a cost allocation method. The depreciation process is simply a way to taking a small piece of that cost that we have on our balance sheet as an asset and taking that over to the income statement as an expense, and we'll call it depreciation expense, little by little over its useful life. So you can see that the description here, we have this asset on our balance sheet in the plant and equipment category, and as we are using those assets over its useful life, we are then going to transfer a piece of that asset over to the income statement as an expense. So depreciation is a cost allocation method. It has nothing, and I repeat, it has nothing to do with trying to match our asset to fair market value. A lot of students get that confused. Okay, just a couple of terms that you need to get used to as we go through this particular study of depreciation. First, something called book value. What book value means is the original cost that we have on our balance sheet as an asset minus accumulated depreciation. What accumulated depreciation is, we're going to call it a contra asset. And basically what the accumulated depreciation is accumulation of all of the depreciation expense journal entries that we've made in the history of owning that particular asset. And what we're going to do is we debit the depreciation expense when we do so. And instead of crediting the actual asset directly to reduce it, we're going to credit this contra asset called accumulated depreciation. For those of you that speak Spanish, you know what this word contra means. It basically means it goes against. So a contra account is going to work in the opposite way or against the actual account. So if an asset has a debit balance, running balance, that would mean that a contra asset would have a normal balance of a credit. Okay, so let's take a look at one of the types of depreciation methods. And I have to say that this is the most common used depreciation method. And the reason for it is extremely simple. This is called straight line depreciation. Now, if you think of the straight line, that means there's no wrinkles in it, there's no curves. It is simply a straight line. And so when we say straight line depreciation, what we mean is the depreciation every single year is exactly the same. It's a straight line, if you will. Here is a formula for straight line depreciation. The numerator is going to be your original cost of purchasing that asset minus something called residual value. Residual value, sometimes also known as salvage value, is simply a number, a dollar amount, that the accountants place on that asset when we buy it. And basically this value represents what we believe it's going to be worth when we are done using that particular asset. A lot of companies will just resort to making the residual value zero because the thought process is, when I am done using it, it is ready for the junkyard. That could be true. It could not be true. Obviously, there may be a reason to make the residual value higher than zero, but a lot of companies do just resort to zero there. And your denominator is years of useful life. That, once again, is determined, it is subjective, it is determined by the accountants when that asset is purchased. There are industry norms, I would say. If you would be comfortable if you said computers would have a 3-year life, vehicles 5 to 7-year life, furniture probably in the 7 to 10-year range, buildings closer to 30 years. So you can see there are industry norms that are pretty much universally accepted, even though it's an accounting estimate. There are other types of depreciation methods that we will study here. First, I'm going to show you straight line. I'm also going to show you an example of an accelerated method. Basically, with an accelerated method, as you can see this depiction here, straight line depreciation is the same every year. If this is an asset that has a 5-year useful life, you can see with the straight line method, the annual depreciation expense is the same every single year. However, with the accelerated method, the thought process is as follows. When the asset is newer, it's working harder to generate more revenue. It's not breaking down, and it's just working like a charm. Let me give you an example of a delivery vehicle. All right, and when it's brand new, that delivery vehicle is never in the mechanic shop. It's buzzing around town, delivering whatever our goods are that we're selling to our customer. And as the vehicle gets older, what's happening? It's breaking down a little bit more. It's in the mechanic shop a little bit more, and it's producing less revenue. So the thought process is take more depreciation expense up front, and as the years go by, we take less and less. Okay, here's an example. Let's actually put this into practice now. First, the straight line method. On January 2nd, S&G Wholesale Grocery acquires a new delivery truck. The truck costs $17,000. It's got an estimated residual value. Remember, that's the value that we believe it's going to be worth after we're done with it. It's got an estimated useful life of 5 years. Compute the annual depreciation using straight line depreciation. And as we said a few moments ago, the formula is as follows. The numerator, we're going to have the cost less the residual value. So in this case, $17,000 is the cost, minus the residual value is $2,000, divided by its estimated useful life, which is in this case 5 years. So using straight line depreciation, we're going to depreciate this asset $3,000 a year for 5 years. And your journal entry, and you can see here's a little table that shows you in year 1. The journal entry is going to be to debit depreciation expense. As we've learned in our earlier chapters, expenses are always debited. And we're going to credit, instead of crediting the asset account, the vehicle account directly, we will credit its contra, called accumulated depreciation. So after year 1, if we recorded a $3,000 credit to accumulated depreciation, that's the running balance at this moment in time. So if the book value remember what the book value was. It was the cost minus the accumulated depreciation. So if the original cost was $17,000 minus $3,000 accumulated depreciation, the book value at the end of year 1 is $14,000. You do the same thing for years 2, 3, 4, and 5. $3,000 a year is going to be the credit to accumulated depreciation. So as an example, after year 2, the accumulated depreciation balance, instead of it being $3,000, it's now $3,000 plus 3, or another $6,000. $6,000 subtracted from the original cost of $17,000, the book value is now $11,000. If you work all the way through this schedule, you will see that after we are done fully depreciating it, the net book value is the same as the residual value, also known as the salvage value. Okay, sometimes we don't buy an asset exactly on the first day of the year. Some companies will use what's known as the half-year convention. So in the example I just showed you, when we had a vehicle that had a 5-year useful life, what we would do is if we buy that asset in the middle of year 1, we would take a half year's worth of depreciation in year 1, take a full year's worth of depreciation in years 2, 3, 4, and 5, and we take a half year's worth of depreciation in year 6. Still, it's a 5-year useful life. We just broke up in the first year and the last year a half year's worth of depreciation. This is called the half-year convention. It is very common. Let's take a look at the example. Using the half-year convention, assume an insurance company purchases hundreds of desktop computers, and at various times throughout the year. The total cost is $600,000. No residual value. We're going to assume, as I said earlier, computers typically have a very short 3-year life. So, straight line depreciation, your numerator is your original cost of $600,000 minus your residual value, in this case 0, divided by, and the denominator is going to be the useful life, in this case 3 years. If you do the math, that works out to $200,000 a year. If we used a half-year convention, that would mean in year 1 we would only take half of that amount, or $100,000, as our first year's worth of depreciation expense. Okay, so that is the first method, and like I said, that is the most common method. The second method that we're going to take a look at is an accelerated method. And with the accelerated method, we are going to see that there is more depreciation in the earlier years, and as the years go by, we're going to see that the depreciation amount gets smaller and smaller and smaller. So the first method we're going to use is called the double declining balance method. And basically what this means, let's think about this, double declining balance. We are going to take the straight line depreciation rate and double it. Let me show you an example. The same delivery truck, if you recall from a few slides ago, S&G buys that new delivery truck. It was $17,000. It had a $2,000 estimated useful life, and it had a residual value of $2,000 and an estimated useful life of 5 years. 5 years in percentage terms, let's think about this. 5 years is 1/5 or 20%. If you double the 20%, what do you get? 40%. So that is what we're going to use, 40% in the double declining balance method. And what will this 40% be multiplied against? This 40% will be multiplied against the net book value at the beginning of every single period. Let's take a look at the table. So this is an asset in year 1. Remember what the net book value is. The net book value is the cost minus accumulated depreciation. Well, in year 1, the beginning net book value is the same as the cost. $17,000. Multiply it by, in this case, our double declining balance is 40%. 17,000 times 40%, you get $6,800. So your journal entry in year 1, debit depreciation expense, credit accumulated depreciation. So if our original cost was $17,000, minus 6,800 is the accumulated depreciation. That gives me a book value at the end of year 1 of 10,200. So in year 2, we're going to take that 10,200 as the computation, the beginning net book value, times 40%. So in year 2, the depreciation expense is 4,080. You see how it dropped? In year 1, it was 6,800. In year 2, it's 4,080. So the accumulated depreciation, it was $6,800. But now that we're recording a journal entry in year 2, debit depreciation expense and credit accumulated depreciation for 4,080, the new running balance in accumulated depreciation is now 10,880. Subtract that from the original cost of 17,000. We are left with a book value, once again, cost minus accumulated, of 6,120. Take that to year 3, multiply it by 40%. You see how it's going down every year? And by the time you get to year 5, the last year, you almost can't even use the 40%. You just got to make sure that it stops where the total depreciation equals 15,000. So the ending book value agrees with the residual value. The original cost of 17 minus the accumulated depreciation is going to equal your book value. Now you know how you can check yourself also with this table? If you add up the accumulated depreciation and the book value on every single line, you will see that they add up to 17,000. 6,800 and 10,200 is 17,000. 10,880 plus 6,120, 17,000. All right, so our original cost of 17,000, it's either going to be basically that represents the book value plus the accumulated, or as I stated before, the cost minus the accumulated depreciation will equal the book value. So that's the double declining balance method. Most companies use straight line for their financial statements. For tax returns, they use more of an accelerated depreciation method. Their thought process is different. On the financial statements, straight line makes sense. It's easy to calculate. It fairly states net income. But with an accelerated method for the tax return, the idea is the taxable income is going to be smaller in years when we buy the asset. And that's typically what companies want to do. It makes sense because there was a large cash outlay, most likely, to buy that asset. So they want to reap the benefits of the smaller taxable income. This is all legal. And when we say companies keep 2 sets of books, this is actually true. 1 set of books for the accrual basis financial statements, and of course 1 set of books for the tax return. Different methods could be used. Okay. Sometimes as we are using the asset, we realize, oh my goodness, we were way wrong with the estimated useful life. And when this happens, this is called a change in estimate. And you don't go back to the first and change it from the beginning. Nope, you don't do that. What you do is you take a look at the change at that moment in time where you realize the change in estimate, and you use the new estimate on a go-forward basis. This is when you have a change in estimate, a revised estimate. You don't go backwards and restate what you've already recorded. You don't go back and redo prior years. You take this and you go forward. Let's take a look at an example. Assume a company acquires a $10,000 asset. It has a 5-year useful life, no residual value. We've been going along with that 5-year useful life for the first 3 years of the asset. And then in the beginning of year 4, we realized, whoa, wait a minute. This asset is going to be good for 5 more years, not 2. Right? We were thinking originally it was going to be good for 5 years. So at the beginning of year 4, there's only 2 years left, right? Year 4 and year 5. But no. We've come to the conclusion this asset is really, really efficient. It's really good. It's going to be good for 5 more years. So what we're going to do is we said, okay, we've already depreciated this asset for 3 years. and it's going to be good for 5 more years. That means it's new. Our new revised estimate of useful life is now 8 years. So from year 4 on, we are going to use that new revised estimate for depreciation purposes. Let's take a look at an example using some numbers. So the original cost of this asset was $10,000. Now originally we said that this asset, which had no salvage value, was going to be depreciated over 5 years. So if we take the 10,000 divided by 5, that means depreciation would have been $2,000 per year. Well, we did that for year 1, year 2, and year 3. So $2,000 a year for 3 years. We've already depreciated this asset $6,000. So the remaining book value at the beginning of year 4 is $4,000. And like I said, starting in year 4, we said, hey, this asset's going to be good for 5 more years. So we will take our remaining book value of $4,000, divide it by 5, right? Because we have 5 more years to depreciate it. So on a go-forward basis, starting in year 4, our depreciation expense is going to be $800 a year. No longer $2,000 a year. It's now going to be $800 a year. So you go forward. You don't implement the change and go backwards and restate what you've done already. That's a no-no. Okay, off of the subject of depreciation. Impairment of plant assets. Sometimes the asset could be completely impaired and it is impossible to get its value back. Let's say through new technology, the fixed asset that we purchased became irrelevant. A new technology renders the equipment that we bought obsolete. That is a permanent impairment of the fixed asset. When we have a permanent impairment of the fixed asset, we are actually going to record a journal entry to reduce or write down. You'll hear an accountant say, write down the asset value to the original cost, to its fair value. And the debit goes to something called impairment loss, which is recorded on the income statement, and it reduces net income just like an expense would. All right. Another method we could use for depreciation instead of straight line or double declining balance, we could use units of output. And this could be used whenever we have an asset that's going to be good for a number of units. A good example would be a truck. And the units of output for a truck is miles driven, right? So let's take a look at this example. Consider Marpole Company's delivery truck. It costs $35,000. It's got an estimated salvage value of $5,000. That's still your numerator, your original cost, less the salvage or residual value. So that would be 35 less the 5. Now, instead of saying how many years the truck is going to be good for, we're going to say how many units of output is it probably going to give us. So the assumption is management plans to retire the truck after it's been driven 60,000 miles. So that is its useful life to us. It's not 5 years, it's actually 60,000 miles. So when you do the math, your numerator, cost less your residual of 30,000, divided by the number of miles, in this case 60,000, that gives us 50 cents per mile. So we're going to depreciate this asset 50 cents for every mile it is driven. So after it's fully depreciated, we would have depreciated this asset for $30,000. Example, in year 1, the truck is driven for 17,000 miles. So if we take 17,000 miles times 50 cents per mile, in year 1, we would recognize depreciation of $8,500. Journal entry, debit depreciation expense, credit accumulated depreciation, the contra asset, for $8,500. Okay, MACRS. I'm not going to teach you MACRS, but MACRS is basically an acronym for Modified Accelerated Cost Recovery System. This is an accelerated method of depreciation. It is used on tax returns. Don't worry about the sum of years difference. Okay, and the last part of this chapter dealing with disposals of fixed assets, of plant assets. Of course, there's another section to this chapter dealing with your intangible assets, but the plant assets, the last subject matter in plant assets. So we bought the asset, we depreciated the asset, now it's at the end of its life. Now we're ready to dispose of the asset. When we dispose of the asset, if we sell it, we're going to debit cash. We will also get the asset off our books. It's gone. So we'll credit the asset and we will debit its contra, the accumulated depreciation. Now, if we sold it for more than its net book value, we have a missing credit in the journal entry, and that credit is going to go to what we're going to call gain on disposal of plant and equipment. If we received less cash than the net book value, that means we sold it at a loss. And that would mean that the journal entry is missing a debit, and we would simply record a debit to this loss on disposal of plant and equipment. Gains and losses are recorded on the income statement, just like revenues and expenses. And I think it's pretty much common sense, I would hope, that you think that gains work like revenues because they're both credited and they increase net income. Losses work like expenses. They're debited and they reduce net income. And that's what I just said. If cash is greater than the book value, you've got yourself a gain. If cash that we're receiving is less than the book value, we have ourselves a loss. If cash equals the same amount as the book value, there's no gain and no loss. It is a perfect sale. Let's take a look at this example. Assume a machine costs $10,000. Now, while we owned that machine, we depreciated it a total accumulated amount of $8,000. Therefore, the book value is $2,000. If we sell this asset for $3,000, we have ourselves a $1,000 gain. So here is your journal entry. We received a check for $3,000, so I'm going to debit cash for $3,000. We're also going to get the machine and its contra off the books. So machinery is an asset. It's got a debit balance, so I'll get rid of it with a credit. The accumulated depreciation has a credit balance, so I'll get rid of it with a debit, and we're missing a $1,000 credit to balance the journal entry. And as I said, that is going to be recorded as a gain on disposal of plant assets. Gains are recorded once again on the income statement. Gains work like revenues. They increase net income. Sometimes, and some of you have done this in your personal lives, instead of just disposing of the fixed asset or selling it outright, you might trade it in for a newer asset. Okay, let's assume Rancho Landscape, they exchange an old truck for a new truck. The new truck cost $25,000. They received a $35 trade-in allowance on the old truck, and the old truck had a book value of $2,000. Well, we're going to compare the trade-in to the book value. The trade-in, they're giving us $3,500, even though the book value is $2,000. The difference between the trade-in and the book value is either a gain or a loss. In this case, they're giving us $1,500 more trade-in than the book value. So this is going to be a $1,500 gain. We pay the difference in cost of $21,500. New truck, $25,000. Trade-in, $3,500. If you take the difference between the two, that is what we need to pay, $21,500. So here is your journal entry. We're going to put the new truck on our books. The new truck, the asset, is going to be debited, $25,000. We're going to get the old truck off the books with a credit. Remember, it had a debit balance, so I'll get rid of it with a credit. I'll get rid of its contra asset, the accumulated depreciation. with a debit. I wrote a check for $21,500, so I'll credit cash. And the difference is we're missing this credit. And as I explained earlier, that is a gain because the trade-in allowance they gave us was higher than the actual book value. Okay, let's take a look at intangibles. There are many intangibles. I'm not expecting you to know all of the amortization principles dealing with intangibles for the exam because there are many of them. But I do want you to be familiar with what an intangible asset is, what they really are. Okay, intangible assets, because there's no physical substance, we don't use the word depreciation. We actually use the term amortization. I know that's a mouthful, amortization. I believe some of you may have heard this term before, especially those of you that own a home. You may have heard that when you sign a mortgage, that your mortgage is basically going to be amortized over the life of the mortgage, which basically means you're going to pay down that mortgage over time. All right, amortization of an intangible asset, as I'm trying to tell you, it's basically the same as depreciating a tangible asset. You are going to record, and the journal entry is going to be debit amortization expense, and the credit is going to go directly to the intangible asset. There's no such thing as a contra intangible asset. We will credit the intangible asset directly. Unlike with our tangible assets, we used a contra account called accumulated depreciation. Okay, straight line method is usually used. Okay, so now for some vocabulary terms. Goodwill. Goodwill represents an amount the company has paid to acquire assets of another company that are greater than its value. Okay? There are many reasons why a company would want to do that. Maybe there's a favorable reputation. We're going to gain more market share. Whatever the case may be, if we paid for assets that are greater than their book value, the difference between what we paid for it and the book value of what we purchased is called goodwill. Okay? Goodwill will not get amortized unless we see that it's been impaired. It is a long, complicated process. I will not teach it to you in this class, but that's what goodwill is. A patent. This is the next intangible asset. A patent is an exclusive right granted by the federal government for manufacture, use, and sale of a particular product. Patents are usually granted for 20 years, and the amortization should not exceed this 20-year period. All right, and we can see an example here. Assume a patent is purchased from the inventor at a cost of $100,000 after 5 years of its legal life have expired. So if the patent had a 20-year life and we're 5 years into it, we only have 15 years left. So we will amortize that $100,000 patent intangible asset divided by 15. That works out to $12,500 per year. And you can see our journal entry, debit the amortization expense and credit the intangible asset directly, patents. Trademarks. All right, a trademark is basically it's a symbol, it's a name, it's a design that can clearly identify a product. So, as an example, you're driving around and you see the golden arches, right? You know immediately that's McDonald's. All right. I can name a million of them. You see the Microsoft symbol. You know you're talking about Microsoft. That is a trademark. All right. So trademarks, obviously, there's a cost to develop the trademark and the brand name. That's an expense as it's incurred. It doesn't add up to an intangible asset. Okay. If it's purchased, instead of developed, if it's purchased, that cost will be capitalized and it'll be amortized over the time period that the trademark is expected to be used. Okay. All right. Franchise. A franchise is a right granted by a company to conduct work under a certain type of business. As an example, you probably know, like let's take Subway as an example, the Subway restaurants. If you wanted to open up a Subway restaurant, you would be called a franchise. You would be called a franchise. You would actually need to pay Subway, or in the example here on your screen, it says McDonald's restaurant. You basically get the exclusive right to operate a McDonald's or a Subway. Franchise costs vary greatly. A lot of times they're very, very substantial. When the cost is material, amortization is based on the life of the franchise, which will be defined in the franchise agreement. Once again, I'm not going to ask you to memorize all these amortization methods. I just want you to get familiar with what the intangible assets are. Copyright. A copyright's an exclusive right granted by the government for basically art. And the copyrights are good for the life of the creator plus 70 years. All right. And when a copyright is purchased from an existing owner, we would capitalize that, and it would be an intangible asset, and it would be amortized over its useful life. Okay. R&D, research and development costs. A lot of companies, especially pharmaceutical companies, comes to mind. They spend a lot of time on research and development. R&D never is capitalized. This is one thing I want to say. A lot of companies want to capitalize it, but they can't. Research and development is an expense as incurred. And last but not least, we're going to turn our attention to, after tangible assets and next intangible assets, and last but not least, natural resources. This is when a company have mining properties, oil, gas reserves, timber. Basically what's going to happen is when we buy the natural resource, we have to estimate how much of that natural resources can be produced from that land, and we would deplete it over its useful life, or as we mine. Let me give you an example. All right, here's an example. Okay, Rainbow Materials pays $48 million to acquire the Red Valley mine. Now, at the time we buy the mine, it is believed to contain 5 million tons of coal. How they come up with that estimate, I have no idea. I'm a CPA. I don't estimate the number of tons of coal in a certain mine, but obviously they have their ways to figure this out. Okay, so that is the estimate. The residual value of the mine, so after we're done removing all the coal, we estimate that the mine is still going to be worth $8 million. So we are going to deplete the coal over as we mine it. So the numerator is going to be the original cost, which was $48 million, less the salvage value of $8 million. So your numerator in the depletion example is going to be $40 million. Once again, the $48 million less the 8. And we're going to take that $40 million and we're going to divide it by 5 million tons of coal. That math works out to $8 per ton. So as we mine the coal, that mine comes out of the coal comes out of the mine. That coal becomes inventory. And we discussed inventory in the last chapter, and we're going to study it again in the following chapter. Okay, $8 per ton. All right. So if we mine 2 million tons of coal, 8 times 2 million, that's 16 million. Look at the journal entry. You're going to debit another asset called inventory for $16 million. And that makes sense because we're going to now sell that. This is now merchandise, if you will, ready for resale. $16 million. And we're going to credit the contra asset called accumulated depletion. Okay. And as we sell the coal, we will obviously debit the cost of goods sold, and we're going to credit your inventory account. Okay. That is an example of natural resources. So in summary, we've looked at the acquisition and the depreciation and the disposal of tangible assets. We took a look at the various types of intangible assets, just so you're familiar with the types of intangible assets. And lastly, I showed you an example of natural resources.